add to that, the RBI has actually gone ahead and eased project finance norm for banks as well. The NBFCs, Lata tells us that they will be benefiting from all of this. In fact, what we'll do is let's go across to Lata, who has broken this data down for us to tell us how the prospects are improving for the banks and NBFCs, specifically on project financing. Lata.
The draft rules on project finance were very strict. Compared to that, the actual rules which were announced yesterday, that is Thursday, are relatively easier on banks. Basically, it refers to how much you must set aside as provisioning when you give a project finance loan. Because in the past 10 years, during the infrastructure loans boom period, a lot of them went bust. Now, the RBI's move was in the draft rules that more money be set aside in good times so that even if they go bad, you can adjust. But to come to the rules say that banks have to keep a provision of only 1% for a project finance loan. The draft rules had set 5%. At the moment, banks keep only 0.4. So it's more than now what it is now, but it is much less than what the draft rules threatened. In case the projects were delayed, they are called DCCO deferment. What is DCCO? It is date of commencement of commercial operations. If it is delayed, then you have to keep an additional 0.37% of the total loan amount as provisioning for every quarter. The draft rules had said it should be 2.5%. Compared to that, again, it is lower. Then for commercial real estate, the new rules require 1.5% of the loan to be kept as provision. Again, the draft rules were 5%. Once the project becomes operational, under construction, you have to keep 1%. Once they become operational, the new rules say treat them as any loan and keep only 0.4% as provision. The draft rules had said even when they go into operation, you have to keep 2.5% as provision and then slowly bring it down over 5 years. So the point is the new rules which become applicable from October 1st are far simpler. What is more important, they apply only to prospective projects, not to projects which are already given. That was another thing which was pressuring bank stocks and the NBFC stocks. NBFC stocks which will also find relief because of this are PFC, REC, IREDA. But in the case of the NBFCs, just one point to note is they already provide more than banks because they have what you call ECL norms, expected credit loss norms. So for them, the change is really not much.